talk a little bit about the outlook on retail participation in equities, largely owing to the massive volatility that we've seen. Has there been a drop in retail participation, and is that keeping investors at bay? We've got Prakarsh Gagdani, who's the CEO at 5paisa.com, as well as Amisha, Vora chairperson and MD at Prabhudas Leeladhar. Thank you so much for taking time out and joining in. I just want to understand, Prakash, are you seeing, owing to the kind of drop that we've witnessed, owing to the acute volatility, has there been an impact in terms of the retail investor participation?
Hi, very good morning. First of all, thank you for having me on your show. As you rightly said, the retail participation has been muted, and not just for a while. If you look at the entire, 2022 full calendar year and now, the retail participation overall has been dipping a bit, and that's largely, if you compare that with the kind of the Nifty which went up, or all the indices, be it mid cap, small cap, large cap, went up in 20 and 21. Retail participated in full flow, demat account spiked, participation spiked. But after that, now for the entire last 12 to 14 months, markets are as sideways. And we all know that retail normally participates in mid cap, small cap, small ticket size kind of investment. And that is where, because of lackluster return, retail participation on actively, which is on the secondary market, is muted and is going down. And that's visible from the retail turnover that you see on the NSE, which last year from almost 35,000 crore, now we are at 20,000 crore on a daily basis. So that's definitely down. And in comparison, what has happened is that the other traditional asset classes like gold has given very good returns because of interest rate rising. The FD rates, which used to be around in 3.5-4%, is now some banks giving almost 7.5%. So when you get these kind of returns in other assets vis-a-vis lackluster performance in equity, obviously the retail will shift, and that's the result. We see a muted performance by retail in the cash market.
Amisha, good morning. So nice to have you back on ET Now. Is there a drop in retail interest? Is there a drop in retail activity? Do you think retail investors are now asking a very basic question that why are we in the market? Because the days of lockdown when we were sitting and trading and making money, that's over?
Yeah, Anuj, I think we have to look at this entire thing in last 3-year parallels. If you look at most of the demat the demat holders, the retail investors have come in last 3 years from the start of pandemic. We almost at from 3.5 crore demat account, now we are at 11 crore demat account. So practically you can say that most of the people came in the start of pandemic, where for the first year the Nifty gave 150% return. So most of the people thought that there is no asset class better than equity, which can give 100% return every year. But that is, people who are seasoned in the markets, who have spent 10, 15, 20 years, know that it's a cyclical market, and sometimes it goes and gives phenomenal returns, and then there are lackluster period for almost 2 to 3, 3, 4, 4 years. So that's something which has not happened for a majority of customers.
Okay, that question was for Amisha. I know, Amisha, you must be thinking that if you have started the show with you. Ladies first always. So how you been, Amisha? Long time.
I'm very good. And Nikunj, one important thing to keep in mind is that particularly during those COVID times, most of us were confined to homes. And if you see it on a very larger map, the working capital used in the businesses or any other modes were all released. So there was ample time and there was ample money. And the only activity which was on was markets. So it saw a gush of new investors coming in. I think out of that, those who really went for mutual fund, then the SIP thing is continuing. But those who started trading on their own have not only found last 1 year very sideways markets, but also that their own businesses are needing money as the actual economy is doing better. And apart from that, time at their hand is very limited. I always say that, in retail, there are discount brokers and there are advisory-led brokers. So the brokerage at discount brokers is really low, but the time consumed, if you add to that, is really high. So I think a combination of factors is at play, and particularly time and money available only for markets has reduced.
Amisha, so are you calling this the new normal? Is this the normalized trend that we should expect going forward?
If you're asking me, I would say that no. Uh, this is also combined with a fact that FI flow has been consistently negative. So when we will see a time when on a after a little consolidation in markets that we don't look too costly or little overpriced as compared to the growth prospects and also as compared to the competitive other markets, I feel that with their flow starting, the overall activity also will start because market always need, and particularly retail always needs a leader, uh, and that they try to follow in terms of volume. And one of the other reasons also can be, and it is, that a safe fixed income return now is much higher than what we were seeing during those COVID days. So a fixed income, when gives such high returns, the risk adjusted equity returns really takes a knock, and which is also one of the key reasons.
Okay, Amisha, that point is taken. The reason of why, there has been a shift from equities to the rest of the asset classes as well. But going forward, what do you think will be the key triggers for the markets to kind of see a bit of a pullback? It'll be remiss of me if I don't ask you on the markets at the moment as well. When do you see the participation coming back and a bit of enthusiasm because it's been fairly lackluster with lack of participation?
So I think markets will take a little while. We were looking at a very range-bound market, anyways, because it is juxtaposed with comparatively good economic macros, slightly deteriorating economic micros, and above all, the liquidity is continuously reducing in the system. As RBI continues to try and protect the currency, gradual illiquidity is getting reduced in the system. So, in that scenario, to expect a runaway rise in Nifty is difficult, according to me. And as we all know, how we had a hockey stick run in the markets when we just opened up, I think that's really been happening in China and the related markets as they have finally opened up post the pains of last 1.5 years. So a lot of attention and investments is going there. So it will take a time while before we break this very range bound markets.
It's going to take a bit of a while before we break out of the range as well. But Prakash, wanted your sense if you can help us with some more data in terms of which segments are seeing the maximum amount of weakness. Is it that the participation of retail is lower in F&O or even in terms of cash market? You're seeing that the volumes are on the lower side as far as retail participation is concerned.
See, what has happened is that broadly the participation in the cash segment has reduced. One is obviously the markets and the kind of performance. Second is the leverage part, which was broadly there up till late 2020, had because of the regulatory change went out. So now it is a standard leverage that is allowed in the cash segment. So a lot of traders who are trading intraday in cash segment turn towards derivative segment, and that's why you see a very good participation in derivative segment, whereas the turnovers have almost gone up by 2 to 3 times. So a good section of traders have moved. So that was one impact on the cash market and a positive impact on the derivative market. So overall, if you look at cash market is the one which is being beaten down, and the turnovers we have seen almost half in last 12 months.
So turnovers have halved as far as the cash market participation of the retail segment is concerned. But Amisha, as well as Prakash, appreciate you joining us on ET Now today. Thank you so much for making time. But